In this short module, we look at the structure of the profit and loss statement. The profit and loss statement is also referred to as the income statement or statement of operations. The objective of the income statement is to match the cost of earning revenue in a period to the revenue earned in that period. The income statement presents financial information that reports how the company performed in a particular period. The first line item in any income statement tells us what revenue the company earned in that period. The revenue earned by the company refers to the total value of goods or services delivered to the customers in the period. Revenue is recognized independent of cash received. If the goods or services have been delivered to the customer, then the revenue is recognized. The income statement has got nothing to do with cash. Revenue is also referred to as sales or turnover. These three terms are equivalent. These three terms are also practically equivalent to net revenue, net sales, or net turnover. The revenue earned by a company in the period is matched with the cost of goods sold. The cost of goods sold is often referred to as the cost of revenue or the cost of sales. The cost of goods sold line reflects the cost to the company of delivering the revenue. For a simple shop, the cost of goods sold is based on the cost to the shop of purchasing the items that were sold. For a manufacturing company, the cost of goods sold includes the cost of the raw materials plus the cost of converting the raw materials into finished goods. The difference between the revenue and the cost of goods sold is the gross margin. Gross margin is also referred to as simply margin or gross profit. As the financial statements are prepared on a consistent basis by all companies, users of financial accounts can compare the performance of different companies by calculating the gross profit percentage. The gross profit percentage is calculated by comparing the gross profit with the revenue for the period. It's only relevant to compare companies that trade in similar sectors, so a user could compare two electronics companies' gross profit percentages or two pharmaceutical companies' gross profit percentages. It would not be relevant to compare the gross profit percentage of an electronics company with the gross profit percentage of a pharmaceutical company. The term operating expenses refers to expenses that are not directly associated with delivering the product or service to the customer. Operating expenses are indirectly associated with delivering the product or service to the customer. Operating expenses include such things as R&D, sales, marketing, and logistics. There is no direct relationship between these expenses and revenue. There is an indirect relationship between operating expenses and revenue. The operating income is calculated by subtracting the operating expenses from the gross margin. As the financial statements are prepared on a consistent basis by all companies, users of financial accounts can compare the performance of different companies by calculating the operating expense percentage. The operating expense percentage is calculated by comparing the operating expense with the revenue for the period. It is only relevant to compare companies that trade in similar sectors. Interest and tax are deducted from the operating profit. Interest refers to the loan repayments that are recognized in the period. Tax refers to tax payments that are recognized in the period. Some companies pay dividends to shareholders. Companies have the option whether or not to pay dividends. A dividend is a cash payment. When we subtract the interest, tax, and dividends from the operating income, we're left with net income.